Welcome to Financial Market Insights for Traders, where we break down the biggest financial trends, market movements, and economic developments shaping the world today. I'm Sophia, and today we're diving into one of the most influential commodities in the global economy, oil. As we move deeper into 2025, crude oil remains at the center of energy policy discussions, investment strategies, and geopolitical maneuvering. The big question for traders, investors, and policymakers alike is, will oil prices continue their upward trajectory, stabilize, or decline as the world shifts towards renewables? Let's break it down. How oil performed in 2024, what experts are predicting for this year and beyond, and what key factors will shape crude oil's price movement in the coming months. Oil market performance in 2024, a year of volatility and supply constraints. Before looking ahead, it's important to assess how oil fared in 2024 because it provides critical context for what may come next. Last year, crude oil saw significant price swings, driven by a combination of supply constraints, geopolitical instability, and shifting global demand. One of the biggest stories was OPEC plus supply cuts. The Organization of the Petroleum Exporting Countries, OPEC, and its allies, including Russia, took deliberate action to restrict oil production, aiming to maintain higher prices despite concerns over slowing global demand. This kept supply tight and supported price resilience throughout much of the year. At the same time, geopolitical conflicts intensified. Tensions in the Middle East escalated further, with recent attacks on shipping routes in the Red Sea, increasing supply chain disruptions. Meanwhile, the ongoing war in Ukraine continued to impact global energy markets, particularly with Western sanctions on Russian oil exports and the retaliatory rerouting of Russian crude to Asian markets. In the U.S., shale production remained strong, but it wasn't enough to fully offset the global supply constraints. Additionally, economic uncertainty weighed on demand, particularly in China and Europe, where inflation and central bank policies created periods of weaker consumption. By the end of 2024, Brent crude was trading around $85 per barrel, while WTI crude hovered near $80 per barrel. However, with new economic uncertainties and continued geopolitical risks, the outlook for 2025 remains uncertain. Oil price predictions for 2025, what the experts are saying. Forecasts for oil prices in 2025 vary widely, depending on economic conditions, geopolitical risks, and supply decisions by OPEC+. Goldman Sachs expects Brent crude to trade between $90 and $105 per barrel this year, citing a combination of sustained demand and ongoing supply constraints, particularly due to conflicts affecting key oil-producing regions. JP Morgan has a more bullish outlook, suggesting prices could reach $110 per barrel if geopolitical risks persist and production remains limited. The International Energy Agency (IEA) takes a more moderate stance, forecasting an average price of $85 per barrel, assuming steady supply from non-OPEC producers and stable demand. OPEC remains optimistic about demand, projecting an increase of 1.2 million barrels per day in 2025, despite global economic uncertainty. And the U.S. Energy Information Administration (EIA) expects fluctuations between $80 and $115 per barrel, depending on how economic growth, central bank policies, and energy market shifts unfold. Key factors driving oil prices in 2025. So, what will determine whether oil prices surge past $100 or remain stable in the $80 to $90 range? Here are the biggest factors at play. First, OPEC Plus production policies remain a critical driver. If OPEC Plus continues restricting output, prices could push higher. However, if they decide to increase production to capture higher revenues, we could see prices stabilize or even decline. Second, global economic growth will play a major role. If the US, China, and Europe experience strong growth, oil consumption is likely to rise. However, if the global economy slows down or enters a recession, demand could weaken, leading to lower prices. Third, geopolitical risks remain a key wild card. The ongoing war in Ukraine, recent escalations in the Middle East involving Iran-backed groups, and supply chain disruptions in the Red Sea have led to increased uncertainty. If conflicts escalate, supply chains could tighten further, leading to sharp price spikes. Fourth, U.S. shale production will be closely watched. If American producers ramp up output, they could offset some of OPEC's production cuts, helping to keep prices in check. However, rising production costs and labor shortages may limit expansion efforts. Then there's monetary policy. The Federal Reserve's decisions on interest rates will influence oil demand. If the Fed cuts rates in mid-2025, economic activity could accelerate, pushing oil prices higher. But if rates remain high to combat inflation, energy consumption could slow, weighing on demand. Lastly, the energy transition continues to reshape long-term oil demand. Governments worldwide are investing heavily in renewables, electric vehicles, EVs, and carbon neutrality initiatives. However, demand for oil in developing economies, particularly India and Southeast Asia, remains strong, ensuring that crude will continue playing a major role in the global energy mix. Potential scenarios for oil prices in 2025 and beyond. Let's map out 3 potential price scenarios for crude oil in 2025. In a bullish scenario, oil prices exceed $115 per barrel. This would happen if OPEC Plus extends or deepens production cuts, geopolitical conflicts escalate further, and economic growth remains robust. Limited expansion in U.S. shale production and continued global energy demand could contribute to sustained price increases. In a moderate scenario, oil stabilizes between $85 and $100 per barrel. Here, we see a balanced market where OPEC Plus manages supply effectively, economic growth remains steady, and U.S. shale output helps keep prices in check. While renewable energy adoption continues, it doesn't significantly impact demand yet. In a bearish scenario, oil falls below $75 per barrel. This could happen if global economic growth slows significantly, OPEC Plus increases production beyond expectations, and alternative energy adoption accelerates faster than predicted. Additionally, reduced energy consumption due to efficiency improvements could cap demand. How traders can navigate oil markets in 2025. For traders looking to capitalize on oil price movements, oil CFDs, contracts for difference, offer a way to trade price fluctuations without owning physical crude. Platforms like crystal ball markets provide leveraged trading, short selling opportunities, and real-time market access, making it easier to trade oil in both bullish and bearish conditions. Final thoughts. Where is oil headed in 2025 and beyond? Oil markets remain highly dynamic, influenced by everything from OPEC policies to economic shifts and geopolitical tensions. While some experts predict prices could push past $110 per barrel, others see a more balanced outlook with stable prices in the $80 to $100 range. For traders and investors, staying informed is key. And for those looking to trade oil CFDs, platforms like crystalballmarkets.com offer the tools needed to navigate this fast-moving market. That's it for today's episode. If you enjoyed this discussion, be sure to subscribe, leave a review, and share this podcast with fellow investors and energy market watchers. Until next time, stay informed, stay ahead, and keep watching those oil charts.